If you're hoping to increase your investment returns, it's important to understand what a dividend yield is. Doing so will help determine if you're getting the most value from your stocks and plan your future investments accordingly. In this episode, we define dividend yield and explain how to calculate it, plus provide example calculations. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best stocks that pay dividends regularly. What is dividend yield? Dividend yield is a stock's annual dividend payments to shareholders expressed as a percentage of the stock's current price. This number tells you what you can expect in future income from a stock based on the price you could buy it for today, assuming the dividend remains unchanged. For example, if a stock trades for $100 per share today and the company's annualized dividend is $5 per share, the dividend yield is 5%. The formula is annualized dividend divided by share price equals yield. In this case, $5 divided by $100 equals 5%. It's important to realize that a stock's dividend yield can change over time, either in response to market fluctuations or as a result of dividend increases or decreases by the issuing company. So the yield is not set in stone. It's most useful as a metric to help determine if a stock trades for a good valuation, to find stocks that meet your needs for income, and to let you know that a dividend may be in trouble. Dividend yield formula. The dividend yield formula is used to determine the cash flows attributed to an investor from owning stocks or shares in a company. Therefore, the ratio shows the percentage of dividends for every dollar of stock. A high or low yield depends on factors such as the industry and the business life cycle of the company. For example, it may be in the best interest of a fast-growing company to not pay any dividends. The money might be better used by reinvesting into the company to grow the business. On the other hand, a mature company may report a high yield due to a relative lack of future high growth potential. Therefore, the yield ratio does not necessarily indicate a good or bad company. Rather, the ratio is used by investors to determine which stocks align with their investment strategy. The dividend yield formula is as follows. Dividend yield equals dividend per share divided by market value per share, where dividend per share is the company's total annual dividend payment divided by the total number of shares outstanding. Market value per share is the current share price of the company. Example: Company A trades at a price of $45. Over the course of 1 year, the company paid consistent quarterly dividends of 30 cents per share. The dividend yield ratio for Company A is calculated as follows. Dividend yield ratio equals 30 cents plus 30 cents plus 30 cents plus 30 cents divided by $45, which equals 0.02666, which equals 2.7%. The dividend yield ratio for Company A is 2.7%. Therefore, an investor would earn 2.7% on shares of Company A in the form of dividends. Pros of dividend yields. Dividend yield is a useful metric when applied appropriately, and the time is taken to understand if the company behind the payout is able to keep paying it. Here are a few examples of how dividend yield can be useful. Income investors, or people looking at their investment portfolio as a source of income today, will rely on dividend yield as a starting point when considering which dividend stocks to buy. After all, if you're living off your portfolio, you have a minimum amount of income you need it to produce. If you're in this situation, you may prioritize stocks that pay the high yield today as long as the business is doing well and its earnings and balance sheet are strong enough to keep the payout safe. Dividend yield can also be a useful tool to help with valuation. If the dividend yield is significantly different from its historical level or is significantly different from similar companies, it can help inform whether a stock is trading for a better or worse valuation. Again, the yield is only the starting point. Knowing what is happening with a company's operations and cash flows is important to help keep the dividend yield in proper context. Cons of dividend yield. The biggest problem with dividend yield is when investors misuse it or rely on it entirely to make their decisions about which stocks to buy and which to ignore. The example of Verizon and AT&T is a case in point. A high yield doesn't matter if there are risks to the company that pays the dividend. AT&T struggled under billions in debt from multiple acquisitions that went badly, leading to a planned asset spin-off that will change the structure of its cash flows and lead to a huge dividend cut ahead. Focusing exclusively on the dividend yield leads to poor investment outcomes with underperforming companies and can also cause investors to miss out on better opportunities. What is a good dividend yield? Before we try to pinpoint a good range for a dividend yield, it's important to note that a stock's dividend yield can change over time due to financial decisions within a company and also macroeconomic conditions, i.e. changes in inflation expectations, interest rates, and productivity growth rates. Generally, well-established companies will pay higher dividends than early-stage companies. Mature companies tend to have more stable, predictable earnings and fewer investment opportunities than growth-oriented startups, a trend which we've often seen in the technology and healthcare sectors. As a result, established companies usually return more cash to their stockholders in the form of dividends. Today, the highest-yielding stocks have dividend yields ranging from 3% to 7.5%, depending on the industry. Across all industries globally, the average dividend yield is about 1.6%. Within the United States, the average is a little lower at 1.2%. Be aware of too high yields. Dividends are just one aspect of a stock's worth. Oftentimes, the potential for stock price appreciation is a much larger determinant of value. Before investing in a stock, be sure to consider its dividend yield as well as its growth potential. Also, be aware that an especially high dividend yield is not always a good thing. Take note of the following scenarios involving high dividend yields. Huge dividend payouts can hurt a company's growth potential and limits its value. Ultimately, every dollar paid out to stockholders is a dollar that a company is not reinvesting in itself. Sometimes a high dividend yield is the result of a sharp stock price decline, not a hefty dividend. The resulting dividend yield looks good on paper, but it's misleading and could keep you from looking at the real story, a tanking stock price. A high dividend yield could be a trick to attract investors. Dodgy companies use this tactic to lure you in, but their dividend payouts are not sustainable. Many times, the company themselves are not sustainable. To get a realistic sense of a company's dividend yield, track it over time through good and bad market cycles. You should also compare it to the industry norm. Frequently asked questions, FAQs. Before wrapping up this episode, here are answers to commonly asked questions by both professional and newbie investors. What is the ex-dividend date? The ex-dividend date, also known as the reinvestment date, is an investment term involving the timing of payment of dividends on stocks of corporations, income trusts, and other financial holdings, both publicly and privately held. What is a qualified dividend? Qualified dividends are ordinary dividends that meet specific criteria to be taxed at the lower long-term capital gains tax rather than at a higher tax rate for an individual's ordinary income. The rates on qualified dividends range from 0 to 23.8%. What is a good dividend yield? In general, dividend yields of 2 to 4% are considered strong, and anything above 4% can be a great buy, but also a risky one. When comparing stocks, it's important to look at more than just the dividend yield. What is the average dividend yield? The average dividend yield on SP 500 index companies that pay a dividend historically fluctuates somewhere between 2 and 5%, depending on market conditions. In general, it pays to do your homework on stocks yielding more than 8% to find out what is truly going on with the company. Do all stocks pay dividends? Dividends are a way for companies to distribute profits to shareholders, but not all companies pay dividends. Some companies decide to retain their earnings to reinvest for growth opportunities instead. How long do I have to own stock to get the dividend? To collect a stock's dividend, you must own the stock at least 2 days before the record date and hold the shares until the ex-date. That's it for this episode. Please give us your feedback in the comments section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.